All right, and we are live. Let's give this a second to sync up as soon as I can see the viewers. There you all are. Okay, it always takes a second. Okay, viewer count trickling in. All right. Good afternoon, good evening, or good morning, depending on where you're joining us from, and welcome to another episode of the AI Circle, brought to you by the iFlip YouTube channel. I am your host, Aaron Yoon, and of course, joining me is none other than the iFlip CIO, Chief Investment Officer, Kelly Korshak. Welcome, Kelly.
Hello, Aaron. Hello, everybody.
Yeah, we've had a little bit of a break. This marks the first episode of October. And I got to tell you, September was a little bit of a brutal month. And October is looking like it's going to turn around, maybe, right? We still have, we're just in the first couple of weeks of October. And so we're going to talk to you all about that. But before we can get into any of that, we have to go through everyone's favorite part of the episode. And let's go through the disclosures. Please bear with me as we go through this. Disclaimer. iFlip Investor Incorporated and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk, and you should speak with your CPA or financial representative to ensure that the iFlip portfolios that you select are suitable for your investment profile before trading in a live brokerage account. And now, with that out of the way, Kelly, I'm going to pass it all to you. Floor is yours.
Thank you very much, Aaron. By the way, you sound a little bit like Robin Williams on an introduction of Good Morning Vietnam. So I just want you to know that's
you
actually a very famous introduction, and your tone and inflection of your voice reminds me of that for some reason.
you
Maybe
caught me. That's who I've been trying to
emulate.
model. No,
Okay.
no, not at all. I'm just kidding. I'm just totally kidding. But I will take the compliment. Thank you.
He's a good man to emulate up until
Well,
the
until
end.
the end, up until the end. I got you. I got you. All right. Thank you.
All right, everyone. Let's. I think we should get to it. Obviously, I was gone last week. I was at a show I think a lot of you might know in Reno, Nevada. And that's why we are doing the AI Circle on this Wednesday, because I was traveling on the last Wednesday. A lot obviously has happened. The world is now at war. Interesting. Just a week ago, we're watching the markets and we kind of understand that interest rates are going up. There are problems in the world, of course. We see the dollar getting stronger. We see the stock market going down. Along comes Poly being a war. A war started in the Middle East, an interesting motif, and markets have responded accordingly. So the main thing most people know when a war breaks out is to, for example, buy defensive stocks, buy U.S. bonds, and buy any kind of maybe consumer staple. That being said, those are the things that were bought. U.S. Treasury bonds were bought. Here comes a chart of that right now. I think it's already up on the screen. If you guys can see it, we're looking at a picture of the 10-year note futures. This little tiny movement, this little baby movement right here, if you could see the mouse, is how the market has responded. We moved on the 10-year note from 4.8%, from 4.5%, from 4.8%, which was the high, literally last Friday, to today, just 4.62% at the close of the day. So we have lost, the interest rates have come down on the long-term bond by 18 basis points. Federal funds has not changed, but long-term bonds, the 10-year bond is a standard, have definitely yields have gone down. But they have gone down, this is a 30-year bond, they have gone down from brand new lows in price, which means highs in rates. And this movement here is minuscule. In correspondence to that, the Dow Jones has rallied about 600 points from the low of last Friday, where we actually rallied, and we've gone up 600 points since that time. And so that is rallied because rates have come down. Another interesting thing to note is the NASDAQ. The NASDAQ has also had a nice little rally, again, because interest rates have come down. That affects the NASDAQ even more. However, I think that's pretty much it. You'll find in the trivia questions tonight, the long-term effects of this are very dubious. The short-run effects generally can be down, but long-term, the stock market does go up. War, interestingly, doesn't have the huge effect on the overall direction of the stock market. So putting war aside, what is the information that we have gleaned from a very small rally in stocks, a very small decrease in long-term interest rates since last Friday? Nothing. This is normal movement in the markets, especially when it comes to the bonds. The bonds are literally the critical issue at this point. The market is following the 10-year note step for step. When you see a longer trend like we have seen here, this, by the way, is the beginning of the COVID trend. This was the COVID high of March of 2020 up here. If you could see it on the screen, there we go, right there. After then, the highs were put in, which means that interest rates were literally, that's where you got those cheap mortgages under 3%. But since then, the interest rates have gone way up. By the way, literally one of the worst movements in interest rates in over 200 years, over such a short time period of 3 years. This means that this little blip is nothing. It is not the beginning of some huge move up that will carry the stock market with it. Interest rates are still going to go higher. It needs to get the fear of the bullets and bombs that are dropping elsewhere in the world out of the way before it will likely resume its direction to higher yields. I expect the 10-year note to be literally over 6% at some time next year. That is an increase from here of about 1.4%, and that means it's an increase of around 23 or 24% higher over the next year. That is a serious move in interest rates. Those kind of rates will, of course, pull the stock market lower if that occurs. That being said, portfolios miraculously are holding up. At the end of the day, since the July highs, the market is really only down it's down 10%, but many of our portfolios are only down 3.5% to 4%. And that's because the markets are holding in and dividends are making up the difference. This is kind of what I do like about holding dividend stocks in this time period. Conservative and balanced, I think, are the right way to go as we weather the storm that we feel could be now, especially through the end of the first quarter of next year. The market is finally moving in a direction that seems to be something we can anticipate. And I think most people see it out there. There's nothing to do with portfolios. The algorithms and machine learning do this for us. That's the good news. The bad news is that periodically markets do suffer drawdowns, and drawdowns are drawdowns. Market does taketh away. The idea is just to not lose as much when the markets do decide to move in a direction that generally is not what we want. We want the market to go higher.
Absolutely.
After all, we're long-term investors.
Kelly, I did want to jump in here and ask you to expand on that a little bit. If the markets are down 10% since the summer highs, since the July highs, and our smartfolios are only down 3.5%, what did the AI do exactly to do that? Did we get out of the market, or like what was the difference?
It depends on the portfolio the person has, of course, and what collection of stocks.
Let's start with the conservative, and then let's also
let's go with the conservative,
and then the balanced.
The conservative and the balanced have something in common. Energy stocks. Energy stocks do two things. They pay dividends. And two, we do have a war in the Middle East. Clearly, we want to be in anything energy. The Middle East is a source of 10% of the world's consumption of oil. So that means America and Europe import oil from the Middle East. China imports oil from Russia and Iran. And so these are countries that have all the oil, and the oil stocks, of course, rallied. And we do own quite a bit of oil in both of those portfolios, balanced and conservative. So, and the reason we want oil, and that's how we've been able to be spared some of the down move in the S&P, is because of this concentration that has done well for us. Mostly because I look at it, and we should all look at it, as a way to be able to collect dividends. Dividends are a form of, they are income, but it's also a form of protection when you have a company that continuously pays dividends because they have cash flows that makes it easy for them to do it. But the other thing, and the more important thing in this instance, is that energy is in demand, and it becomes even more scarce if the world war that, or the war that is occurring happens to be in a hugely in an area that allows for 10% of the Earth's consumption of fossil fuel. It is one of the ways to protect any portfolio, is through a commodity that will become precious, especially during times of strife. So this is how we've been able to sidestep, at least in terms of diversification, a larger diversification into these kind of stocks. I've remained and will remain a large believer in the energy stocks as long as we have this administration.
Right.
This administration is essentially the reason energy stocks are so good. It's because they're trying to literally put them out of business, but yet the world and the market and investors feel that this is a temporary problem, and that the scarcity that the government is trying to create with fossil fuels is being overwhelmed by the fact that these same companies become deeply desired because they're making energy harder to get, which means we have to pay for it, means our prices will be higher for oil. And guess what? Higher prices mean higher profits.
Right. I do have one follow-up here, and then I'll get out of your way. You just got done saying that this administration is doing us a favor as investors anyway by the scarcity that they're trying to create. Now, to what extent does our AI monitor things like that, to depending on who's in the Oval Office, and to what extent does that impact our AI and machine learning? And secondly, like, what about the converse of that? What about the flip side to that? No pun intended. With green energy, like, how is the AI looking at that?
First of all, I mean, there's a lot going on in the world. I mentioned, and I will come back to your questions because they're
Sure.
good. And they also are helpful, I think, to our audience. Remember, the war isn't the only thing going on. We must not forget that we are looking for a Speaker of the House. So geopolitically, we have a war. Internally, politically, we also have a war within the Republican Party. And so you see a world at strife where there's a lot of uncertainty. Generally is a good thing for this US stock market. Stock markets like things left alone. They don't like things that get to interfere with everyday business. So that's one of the reasons I go back to oil, is because you have a government, a local government, the government of the United States, that has got an all-out war on fossil fuel. They complain that they make that it damages the climate. They complain that they make too much profit. They complain and complain and complain, and yet all that does is make these companies more profits. So that being said, owning those stops, machine learning, algorithm or not, makes no difference. At the end of the day, you always want to own stocks that are protective over many different kinds of scenarios. And that is just construction. Machine learning makes no call on who the president of the United States is. Now, however, that being said, it did look at that data. And I have fed that. Who was the president? Not who was the president, sorry. Was it Democratic or Republican Party during the time that you look back historically so you can train the computer to learn. When you build a machine learning model, the machine learning model creates curves meaning ways to trade the underlying equity you're trying to learn the price of, in such a way to say, hey, I like this data, but I don't like this data. Not once does it show that Republican or Democrat is a preferable data set to use in order to anticipate price. So at the end of the day, this is something that a machine does extremely well. It's not so much that it always learns what might be the best thing to do in the future, but it also tells you what information is relevant or not. So in the case of Democrat, Republican, it turns out it's not relevant to the movement of price. Most people think historically that Democrats actually allow the stock market to go up more during their administrations than Republicans. And overall, for the magnitude of it, there is truth to this. Under the Obama administration, the market advanced quite a bit. During the Clinton administration, quite a bit, and much less so for George Bush 1 and George Bush 2. But that being said, in the aggregate, it doesn't. And machine learning, of course, may not have existed long ago, but the data does. And we are not able to find any kind of data that says what administration, Republican or Democrat, does better. So that data I have been able to rule out for use in terms of price discovery going forward. Not enough information. So that being said, machine learning has its uses, but its uses are really additive to underlying risk management and algorithms that tell you when to buy and sell. The beauty of machine learning is that it actually is an algorithm that updates itself and learns from its past. So that kind of goes back to a very important word that we've all heard, and most of us look at this word in the pejorative. It's called backtest. Mm-hmm. A lot of people say that, what good is a backtest? What happened before doesn't matter. It's what we want to do is forward test. Let's test forward. I totally understand this. But for a machine to learn, it must learn from some experience, just like a human being does. So that would be like to say that we want to walk forward is the same, I think, the equivalent in saying, don't worry about the past. It's all about learning going forward. Well, how do I learn going forward when I have no information right this instant? So I wouldn't like to be my age today and then say, okay, I have no information. I'm just going to learn now. Why not take my life's experiences, add them all up, collect them, and make my best judgment how to walk forward with all the information I've learned or put in my mind over a lifetime? Same thing as a machine. A machine learns, and it learns to adapt and make different decisions as new data comes in. So backtesting actually is very important in both the machine learning world and the plain, simple algorithmic world. You must look at the past so that I have a better way of guiding myself in the future. So when you look at the word backtest, don't think of it in people as a word that's negative. Think of it in the context of how to use that to be able to move forward. So a wonderful discussion that I would like to maybe do one day, a Q&A with you on that, Aaron, and we'll post that. In the meantime, I think let's just go over a few more market things because I think they are important.
You got it.
Let's take a look at gold. Here's a market where, again, we have a war going on, and the response of gold is to move from 1820 to 1874. So it's up $50. That's a grand total of 2%, 2.5%. Not much of a move, very similar to the stock market. If we look at let's look at the dollar. I think that's extremely important as well. So I'll go over to, I have to look over here to see if my eyes are terrible. Here's the US dollar index. So this chart going higher, here's the dollar at its highs over here back in late October. I think I showed everybody a few weeks back when the dollar started to come down here is when the stock market went up. Now, as the dollar has been going up here, the stock market was going down. And because of the war, we have this little bleak. Why? Because interest rates fell. When interest rates fall, generally the dollar will get weaker. And the dollar gets weaker, it means that, hey, there's less incentive to move your money to US dollars and buy US stocks. This is one of the reasons why when the dollar is weaker, people anticipate to say, hey, it's cheaper for me to buy a US stock so I can change my money into it and buy it. But right now, look, again, the movement is minuscule. The movements are minuscule. This chart to me looks like a chart that wants to go higher. And if that's the case, interest rates will go literally higher. And that means the stock market probably will move lower. Now, going back to our portfolios, we're still collecting dividends. We're highly focused. These portfolios are designed with a high focus on energy. As long as there's toil in the Middle East, energy will still likely hold on. And even if it doesn't, these dividends are continuing to come in. So that's why red oil has looked very good this year. Conservative has held up really nicely, looking for a return that is actually in pace with a normal S&P return of around 9% with dividends. And we have the balance that did also every bit as good almost as the aggressive this year because of the emphasis again on oil and dividends. So here we are at 3:53, which means Pacific time, which means we're getting close to a few things before we go to the trivia question. Let me kind of show everybody some stocks that I think are relevant here.
Okay.
Let's go to the watch list. Let's go to Apple. I always like to look at Apple. I think I've told most of the viewers that my opinion is that owning the S&P 500 in Apple is probably as good a bet as anybody can make over a long run in history. Using the S&P and Apple, using our methodologies, our tactical trading model called our flagship model, the S&P 500, I think is even better because it is able to sidestep drawdowns. And we've done so at least 3 times in the past. And we also have bought at least 2 of those lows that occurred after those drawdowns. So I believe the ownership of just the S&P 500 Spider and Apple is a good bet for everyone. However, again, that is my opinion, and it is not something that I could prove over time that will be a better bet than other things that people might choose. But the reason I say it is this. This is a stock that over a long period of time, as far back as we could go, goes up. And why does it go up? Because it represents what's best in the United States, and it is now way beyond the United States. 1/3 of its shares of its value comes from example from China. But that being said, is reason I bring this chart up. I think Apple is vulnerable here. I think we love owning Apple. Apple is moved from a price of about 169 at its low down here, all the way back up to approximately 180 area. The high up here was 196. I don't like Apple. I think the issues between the US and China will continue to fester. And as they fester, I think the use of Apple iPhones in China will deteriorate and maybe even be banned. Apple is diligently trying to move its production of their parts and products and manufacture of Apple from China to Vietnam and other areas around Southeast Asia. If that's the case, Apple will lose up to 1/3 of its revenue. That means that one of the reasons I don't like it at the moment, and the AI will probably show this out, is I think it's a possibility that Apple goes down to 120 to 125 over the next year, which case I think it could be an enormously good purchase. But that means it's got at least a 30% correction to go before I think it's a good stock again to buy. That being said, nobody could ever argue buying Apple at a high is worked beautifully historically, but I do believe we are in kind of strange times now. I think most people understand that, and so I like Apple, but I don't want to own it here. So one more, I think we should look at Nvidia. Nvidia is a stock that we had this huge gap. We know that it's AI. Everything AI revolves around this chip that they make that allows the AI to prosper. When we were at $500 a share, all the analysts were predicting 650. It promptly went down to $400 a share, losing 20%. Now it's bounced back to 468. I don't like it because I think interest rates are going up. I feel that this is possibly a selling opportunity for any owners of Nvidia, and we might hopefully see if we can hold in this area and drop down. We will have formed, I've noticed here, you can all see it, a little head and shoulders top, which is something you don't see much. And in a bull market, generally, which this is in, it's hard to be able to say that means that we have some kind of protraced move to back down to around $300 a share. So that being said, I think it's time for the trivia question.
Yes, thanks, Kelly. We do have a very interesting trivia question for today, and let me just pull it up here. Now, just to give you a hint, this is something that you're going to have to go with your gut. This isn't something that's easy. I feel like anything is Googleable, especially with tools like ChatGPT these days, but this isn't something that is quite that easy. So the trivia question for tonight is as follows. What outbreak of war caused the greatest drawdown in the stock market? Now, we are talking American history, so so keep that in mind. Don't go all the way back to thousands and thousands and thousands of years before the stock market even existed. What outbreak of war caused the greatest drawdown in the stock market? So we're looking for an event. We're not necessarily looking for a number. Now,
Which war? Yes. Which war was it?
Yes, exactly. Which war was it? Now, but while you have just a real quick reminder for everyone that's just joining us for the first time, how does the trivia question work? What do you win? And like how does everything work? Well, the prize for tonight is, as usual, it is a $25 Amazon gift card, which, let's face it, might as well be cash. And how do you receive this gift card once you've been selected as our winner? Well, it's not enough that you just got the answer. You also have to qualify, which means that you need to show us that you're invested in at least one smartfolio in the iFlip app. So you can do that by emailing our email here. This email address that you see on your screen, just email mailbag@iflipinvest.com. And you can also just text us at 480-418-0575 either your account number or a screenshot of the smartfolio that you're invested in, and that will qualify you to receive the prize that we'll send via email. Okay, so now let's check out our answers here. We have some answers, but we don't have the correct answer, Kelly. I thought that you were going to be that you were going to stump people. We do have people
fester on it for a little bit while I answer some of the questions I see in the chat.
Exactly. You read my mind. The first answer that we have is the September 11th, which is, I think it's a good guess. It's also not the correct answer, but in recent history, that answer does make sense. So Kelly, we did. Let's let people percolate on this a little bit. Do a little bit of homework and marinate. Let's take a look at some of the
I'm going to
questions.
go back. Let me read from the bottom, and I'll go to Teresa Rivers. She says, "Do some short trades." Um, I do. As you know, Flip. We don't do short trades. We're 85% of the time. You've heard my mantra. The market goes up. Timing for the short side is not for the faint of heart, and I don't really think it's good for IRAs because at the end of the day, I'd rather buy the dip and take my chances with the 85% of the time up than try to guess and be a hero and win on the 15% of the market going down. That being said, if I were to do a short trade in the US stock market and I wasn't using futures, I would use the symbol SH because SH is a one-to-one. It goes the same way as the spider, and it is not levered. It has very little, if no decay. And so if you are going to go short, that's it. And if I were to short the market, it would be somewhere below the 200-day moving average of the S&P 500 index. So that's how I would do it. Um, um, Also, to Lizzie, no, you know I love buffalo wings. Nah, no. If I even with that's a Randy thing. I'll eat them in a pinch if I'm starving. Um,
Yeah,
it does increase in further to Lizzie Bell, uh, which is nice to hear from you again. Of course, it's inflationary. Um, it's extremely inflationary, and the reason is, of course, for what we've already talked about: energy prices going up, manufacturing prices going up. War is always inflationary, and that is adding to the problems we have. It's another one of the reasons that I just can't get my arms around this being some kind of bottom, which I've heard today from two analysts. One of them is my favorite, Ken Fisher, who had a new saying: "You buy when the bullets start, not when the bombs fall." Um, there is truth to it because that is part and parcel of the answer about war. But I don't believe this case is the same given all that's going on around the world. And to Jung Dawn, who I've met, hello. Yes, red oil is not something you time. You buy it. If it pays dividends, you want to own it. I think it is a good defensive mechanism. I think in the short run, it's not. It is energy only. It holds dividends, and some of those things inside of red oil have come down in price. Those are the pipelines and things like that. And so, yeah, I would buy red oil right here, and I wouldn't look back. That's me, in my opinion. Um, can you identify? Yes, the indicators that you see on mine are always this, because we do have long-term approaches. I always look at a 200-day moving average, and those are just a couple of Bollinger Bands, of above and below, two Bollinger Bands above and two Bollinger Bands below. And if you see a little signal in there, that's just kind of an indication of a simple 200-day moving average algorithm where you sell the market when it's below it and buy it when it's above it. There's no efficacy to that, but 200-day moving averages are meaningful, especially in the S&P 500 index and in many stocks. And that's why you keep an eye on it. Otherwise, maybe I could use a 201-day moving average, or the most efficient one actually is 188 currently right now. So, but yeah, it's a good rule of thumb, and I always point it out when I look at any chart, I have that as a backdrop, so I kind of know where price is relative to a long-term moving average. The trivia. I think there's a close attempt by Jim for 6-day war in Israel. Go ahead, Aaron. Spill the beans.
Yeah. So we actually had. Well, we'll see who we decide is the winner, but no one actually got the actual correct answer. The actual correct answer is, let me pull this up here.
And everybody's going to know it when you hear it.
Exactly, right? Pearl Harbor in World War II. Now, Kelly, can you just spend 60 seconds and share with us what is the significance of this. You chose this trivia question for tonight. You thought it was relevant information. What was the thinking behind that, and how is this relevant to us?
I think when war occurs, people obviously immediately think the worst is the first indication. That was also true on Sunday night. And when the futures opened up in Chicago on Sunday night, they were way down. The S&P was down almost 1%. The Dow was down 1%. The Nasdaq was down more than 1%.
It gapped down, actually.
Right, they just gapped down. The futures markets were saying, "Oh, this is bad," and so they sold off. When the market opened up on Monday, it absorbed that, and it quickly quickly recovered a little bit. And then as time bore on and it realized there was no selling, it actually rallied. And so it rallied because and that's why I chose this trivia question. War generally creates an opportunity. And the reason is the opportunity is that there are things that actually do well in war. Again, we can talk about it. Bonds do well in war, right? People want bonds, safety. Bonds right now are paying they were paying 4.8% on the 10-year note. Why not buy some of those? Well, if you buy those bonds, it makes the interest rate go down. Interest rates going down really help the NASDAQ. And they basically will, in this environment, when the stock market is looking literally at the bond, it's going to have a positive effect on it. That's why I chose this trivia question. It is kind of counterintuitive at some level, but this one's really important because in Pearl Harbor, the total drawdown was 19% over like 150 days. The second biggest drawdown was, of course, the Israeli war when they went into what was it?
Kuwait.
Aaron? Yes, sorry, Kuwait war when Iraq went into Kuwait. That one was a 16% drawdown. That one also thought of oil disruption. Oil companies were up during that time, of course. So we do want that kind of scenario. But it was a protracted war and we weren't sure of the outcome. But I will tell you, the country in 1991 was in a lot better shape than the country is now in 2023. So I don't think that we have the backdrop this time around to just look at historical information and draw an immediate conclusion is, hey, this is something good, and over the stock market, it will now have a reason to rally. No, in this particular case, I think the winds are still very much against the stock market in the short run, and we need to clear some things out. So I thought there was a relevance this time around, Aaron, and for everybody out there.
Sure.
To say, hey, what was the worst? It was just plain old Pearl Harbor.
Mm-hmm. So in terms of our winner, help me out here. We have several different answers. We have the 6-day war in Israel. I don't know if that was closer, or if we have
my friend George got the 70 Israelis war. I was thinking that, but that's kind of. Love you, George. Love everybody out there, but no.
And then we have World War I in 1914.
Dudes, I mean, for once, I made that one also because it's not easily Googleable.
Yes, and it wasn't. You stumped everybody here.
I looked it up, trying to figure out which one was the worst. I had my own curiosity on it, and I had to dig. So that makes me feel good that I dug better than most.
Kelly, you're not the winner. You don't get the gift card. You have to. One of our viewers has to get the gift card.
I hate to say it, but nobody was close.
I know. So
nobody was close. Why don't we do a double winner for next week?
That sounds good to me. You heard
it,
everybody.
Is everybody okay with that? I mean, we have nobody that was even close.
That's
to give it to anybody is wrong.
Yeah, right. So we're going to I don't know what the technical term is here, but we will we will. Yes, yes, Teresa, definitely. You have the right answer. Another question, but we are out of time for today, so we will double the mailbag prize winning, which is next week. That is just so that everybody is aware. That is next Wednesday, October 18th, 3:30 Pacific, 6:30 Eastern, with myself and Lee Gearhart, our director of sales. We will double the prize winnings next week on mailbag to $50 for the Amazon gift card. Okay.
And Teresa, if you send your question to info@iflip.com, I'll have Lee keep an eye out for it and see if I can help answer it. And if it's an opinion that I can give, I will forward my opinion.
Oh, I thought she was asking us to present another trivia question.
No.
Okay.
No,
Okay.
I can't think of one off. I don't do two in advance.
Right, exactly. Okay, so we did go a little bit over time. We expatiated on the trivia a little bit, but it was fun. I hope you all learned something about the relationship between the war or wars in general and the stock market price movement in general. That'll do it for our show tonight. Thank you so much for sticking with us all the way to the end, even though we went over a few minutes. If you like this kind of content, please hit the subscribe button, hit that notification bell so you don't miss out on the next live stream, which is important because our prize winnings, our trivia question is going to be worth double. We will see you all next week. And until then, we're going to sign off and say good night, everybody.
Good night, everybody. Take care, Lizzie.